Welcome to the weekly markets update. I'm Marit Sagarishvili, investment consultant at Kamak Retirement Group. Today we are recapping what moved the markets during the last week of January. The US equity markets ended the week lower as a flash mob of retail investors rocked the market, causing headaches for several well-known hedge funds. While the regulators and investors try to digest what this new dynamic means for the markets, the volatility and unusual price moves in a handful of stocks caused the markets to stumble. The S&P 500 index ended the week down 3%, erasing all the gains for the month of January. Last week, we have seen a concerted effort by individual traders on forums like Reddit engage in a coordinated short squeeze of certain stocks, like AMC Theaters and GameStop, causing erratic swings in their share prices. The premise behind the short squeeze was to pressure hedge funds that shorted those stocks to cover their short positions, therefore massively driving up the prices on those stocks. The unusual price action caused trading platforms like Robinhood to restrict trading on those stocks and many others for liquidity reasons. This has sparked a great deal of outrage and controversy from market participants and drawn attention from regulators and politicians. There was no major market moves in US bond market, as all the activity was centered on the frenzied price action in equities this past week. The 10-year US Treasury yield continued to hover around 1% level, closing the week essentially unchanged at 1.09%. The investment grade and high-yield bond markets, which tend to be more correlated with equity prices, also continue to hold steady. Fourth quarter earnings season is off to a good start, with many companies reporting better than expected earnings. According to FactSet, 82% of S&P 500 companies that have reported thus far have a positive earnings surprise, with many beating estimates by a wider margin than the 5-year average. This has pushed the S&P 500's year-over-year decline in earnings to negative 2.3% from negative 4.8% last week. As expected, Fed officials left interest rates unchanged their meeting past week. While the Fed officials expect a strong economic recovery in the second half of the year, monetary policy will remain highly accommodative as the near-term risks are still skewed to the downside. U.S. economic growth slowed in the fourth quarter to a 4% annualized rate as the nation struggled to contain the spread of the virus. Despite the economy's V-shaped rebound from the pandemic, U.S. growth contracted 3.5% in 2020. This marks the worst year for the economy since World War II and the first time that economic growth contracted since the Great Recession nearly a decade ago. The number of Americans filing for the first time in unemployment benefits slightly fell to 847,000. Continuing claims, which report those who are already receiving benefits, declined to 4.7 million. While the trend is in the right direction, the weekly jobless claims filings are nearly 4 times higher than they were this time a year ago. The gap between personal income and household consumption continues to widen. In December, personal incomes, which have been bolstered by the government stimulus programs, climbed 0.6%. While the household spending declined 0.2%. While this divergent trend highlights why the economic recovery lost momentum in the final quarter of the year, it could provide a powerful tailwind to growth once the pandemic recedes and the businesses are able to fully reopen. Thank you for watching. For questions, please visit our website, kamakretirement.com.